In this week's video, we'll review the latest charts and data to help us answer the question, did the Fed just open the door to a strong finish to 2025? Before we get into shorter-term post-Jackson Hole charts, let's first double back to last week's video because this tweet at 11:39 a.m. on Friday, August 22nd seems to tie in nicely. The S&P 500 is on track to close at a record high with more than 90% of issues advancing on the NYSE. That's never happened before. There were two times where at least 85% of the issues advanced. Both kicked off multi-year bull runs. And if you just eyeball this chart and line it up with price, this is the S&P 500 here. In terms of the two times that something similar has happened before, 1982, for the most part, the start of the 18-year secular bull market. The second time is right in this window here, close to this high and this high. Where is that on the bigger chart? It's right here, somewhere close to late 2012 into Q1 of 2013. Also, the early stages of a secular bull market. Thus, the tweet over here from Friday's session and the concepts covered in last week's video both seem to align with this concept. The stock market could still have years of upside, simply telling us to keep an open mind about a wide range of outcomes, including much, much better than expected long-term outcomes. A concept that aligns with what we covered last week and a concept that aligns with this tweet from Friday, August 22nd. Friday was also the Super Bowl of central banking, highlighted by Powell's speech on Friday morning, August 22nd. Headline from the Wall Street Journal after Powell spoke. Powell highlights job market worries, opening path to rate cut. About a half an hour before Powell spoke, 72% odds, based on market positioning, that the Fed would cut in September. After Powell spoke, 89% odds. This movement tells us that the early read and price action during Friday's session says the market thought his remarks were favorable and dovish. And keep in mind, the market doesn't care what you think. The market doesn't care what I think. What matters is the market's interpretation of his speech. Moving from 72% to 89% and looking at the extremely strong and confident market breadth during Friday's session, as well as sector performance intraday, the only red sector was defensive consumer staples. It's very difficult to say anything other than the market liked what he had to say. Source of this study, Ryan Dietrich with Carson Research. In the past, when the Fed has paused for 5 to 12 months and then they resume a cutting cycle, the S&P 500 was higher a year later 10 out of 11 times. It's 91% roughly. Average gain, average additional gain, roughly 13%. Median additional gain, 14.5%. Aligning with all of this and aligning with this. Still from Carson Research, when the Fed cuts interest rates within 2% of a stock market all-time high, the S&P has gone on to finish higher over the next 12 months, 20 out of 20 times. Average gain a year later, 13.9%. Research from a Wall Street veteran. In GDP terms, approximately 80% of the U.S. economy is service-based, including industries such as healthcare, education, finance, and professional services, which are not directly related to trade nor tariffs. 80% of U.S. GDP not directly related to trade nor tariffs. From Yardeni Research, on balance, there aren't a lot of inflationary pressures in the commodity markets. Tweet from August 21st. This tweet and this tweet, they both align with numerous charts that we have covered over the last 8 months that have helped us ask and answer, is the market overly concerned in a showstopper manner about tariffs and inflation? Thus far, the answer to that question has been and still is no. We'll continue to take it day by day. This headline, tariffs aren't dealing a huge blow to big retailers and consumers yet. The yet. Making decisions based on what you think may happen, or maybe even what you want to have happen, is a violation of the concept of trading the chart in front of you. We also trade the data set in front of us. There's another concept related to the importance of trading the chart in front of us. Somewhere in the neighborhood of 350 to 400 million people own stocks around the globe, with perhaps as many as 10 to 50 million trading on a given day. And if we think about the impact of consumers on earnings and thus indirectly on the stock market, you're talking somewhere in the neighborhood of 4 billion people worldwide. And that really underlines the concept, or emphasizes, or shines a light on the concept that the market doesn't care what you think. The market doesn't care what I think. We don't believe that we can predict how tariffs or any other topic are going to make their way through the financial markets and through the consumer-based economy to impact the stock market. Another maxim that's good to keep in your back pocket: you have no idea what's going to happen next. Let me repeat that. You have no idea what's going to happen next. But we know with 100% certainty what the chart in front of us looks like. That's a set of facts. This is a chart of the NASDAQ composite that we covered in July. I believe it was in the July 19th video. We haven't changed any of the markings or annotations on the chart since mid-July. This chart shows us the importance of reference points. If you look at recent price action in the NASDAQ composite, upper right-hand corner of the screen up here, does it look like any of these reference points have been violated? Have we taken out this high back here? We have not. Have we taken out the anchored volume weighted average price line tied to the high up here, or the low down here? We have not. Have the slopes of these anchored volume weighted average price lines flipped from positive to negative, possibly indicating a reversal of trend? They have not. Telling us, for the most part, that we don't have any evidence that the current uptrend is anything other than healthy and intact. And if that's the case, then we should err on the side of holding our positions and treating all volatility as volatility to ignore until the charts and the evidence, the weight of the evidence, begin to suggest otherwise. At a minimum, we want the weight of the evidence to get into a gray area before we even consider selling profitable positions in the context of a secular bull market. Is it possible that the NASDAQ is about to take out these levels here? Absolutely, positively, yes. And it may take out those levels very, very soon, but it hasn't taken them out yet, and it hadn't taken them out prior to Powell's speech. This chart was created during Thursday's session to make sure that we had up-to-date reference points heading in to the Super Bowl of central banking on Friday. Here's a gap up right here in the NASDAQ composite. This is the anchored volume weighted average price line tied to that gap. And as of the close on Thursday up here, nothing had been violated in a manner that would tell us that this uptrend from this point here in June was in jeopardy yet. And we don't have anything in hand relative to the uptrend that began down here in April when the tariff news became less bad. We don't have anything in hand that tells us that this uptrend is on the ropes. The reference points help us reduce our trading frequency. And ultimately, within the context of an uptrend in a bull market, that should improve our profitability over time. Similar concepts here. These are reference points that we covered in the August 8th video. As of Thursday's close, and relative to recent volatility in this region up here, do we have anything in hand heading into Jackson Hole that tells us this uptrend is on the ropes? We did not. That doesn't tell us anything about what's going to happen on Monday morning. It just told us earlier this week, and at the close on Friday, that it is prudent to maintain our investment stance without any changes. And if the market decides to get weak, we have numerous reference points down here that can help us make decisions. Similar concepts here. We covered this chart with these annotations and these reference points on Friday, August 1st. And if we zoom in up here, all the reference points that we covered about 3 weeks ago told us as of the close on Thursday to try to remain patient and to treat this volatility thus far as volatility to ignore. Reference points that we covered in the May 23rd video. S&P 500, we don't have anything in hand that's particularly alarming at this point. On Thursday, we closed above the rising 50-day moving average, the dotted red line. Concerns would increase if the S&P started taking out levels in this region down here. Let's talk about Bitcoin ETFs for a moment. This is the peak on a relative basis here in 2021. These type of ETFs start to look more attractive if this ratio can move away from this dotted line. Concerns would increase relative to these types of ETFs if this on the right side up here starts to morph into something more like this. Small caps had a great week, which is not surprising, especially after Chairman Powell strongly hinted that the Fed may be cutting interest rates in September, and if not in September, relatively soon. Having said all of that, if we look at small caps relative to large cap growth as of the close on Friday, post-Powell, IWM in the ETF world relative to IWY, we're knocking on the door of possibly taking out this anchored volume weighted average price line, and in this case it would be an AWOP line tied to this high up here for the ratio. But if we just look at price action for the ratio, the last thing it did was make a new low. It hasn't made a significant higher high yet. So right now this is still treated as a counter trend move within the context of an existing downtrend. Is it possible, with the Fed shifting gears, that small caps are going to break this relative downtrend? It is possible. That's why we have to keep an open mind about potentially adding small caps at any time. In terms of looking at large cap growth stocks relative to the S&P 500, there's really nothing on this chart here of IWY relative to SPY that tells us anything other than we should try to remain patient with large cap growth stocks. If the ratio, which is now in the upper right-hand corner of your screen up here, moves down into this region here, the longer the ratio stays below this reference point and this reference point, the more concerning it would become. Look at the slope of the AWOP lines here relative to this high and this low here. They're still sloping upward. It's another chart that we've covered in the past. This notation here saying that this convergence of trend look in here is constructive. I believe at the time we said, if you're a bull, the next thing that you want to have happen on this chart is you want LQD to make a higher high above this high here. Well, we've done that. Haven't convincingly moved away from that high yet, but this doesn't look like a bond market that's overly concerned about inflation, about show-stopping economic weakness, nor show-stopping slowdowns in corporate earnings. Similar to the chart of the NASDAQ composite we covered earlier, we don't have anything on the chart of SMH in isolation that's particularly concerning, and that was true as of Thursday's close as well. If we look at a chart that we've covered in the past, the ratio of semis to the S&P 500, SMH to SPY, still in a constructive region up here. Another chart that we've covered in the past with reference points, large cap growth stocks relative to the SPY. In this case, it's SPYG as in George in the ETF world relative to SPY. Anything negative about this chart? Looks a bit extended, so it wouldn't be shocking if the rally broadened out a little bit here and this relative uptrend took a little bit of a break. But this is still really constructive in this region here, the look of these AWAP lines for the ratio. And we don't have anything in hand that looks like the long-term trend is in doubt, especially the trend for the ratio relative to this low here back in calendar year 2023. A good risk-on, risk-off ETF to monitor, ARKF. Post-Powell, after the close on Friday, August 22nd, closed above its 20-day and well above an upward-sloping 250-day in black. Compare the look of this chart. This is the peaking process right here as the S&P 500 peaks in October of 2007. This is Q1 of 2008. Compare this bearish and concerning look in the early stages of the financial crisis to the present day. Do the same thing after you pause your video player. Compare this period, this period, this period, and this period, all concerning periods, to the present day, upper right-hand corner of your screen. Another reference point chart. Covered this chart, daily chart of the NASDAQ on August 1st. None of the reference points from that video have been violated, telling us to try to remain patient. And that's been true from this point here in July to the present day. Concerns would increase if the NASDAQ moves into this region here. It's really helpful to go back and look at charts that you covered previously and the way you annotated them. This chart was annotated in this region saying, this is a constructive look here for the Dow Composite, which really doesn't look anything like this concerning look in 2022. It's another chart that we've covered in the past. Haven't changed any of the annotations. Highly interest rate sensitive, home constructive. Made a stand at an upward sloping 200-week moving average recently and still has a constructive momentum look. Dow Jones Industrial Average above all of the moving averages spanning from the 8-day in blue all the way out to the 250-day in black. As of Thursday's close, we were still checking all of the bullish boxes on the weekly cloud of the NASDAQ 100. True pre-Powell. True post-Powell. NYSE advanced decline volume. Late 2007, crossing over the center line on the Bollinger Bands. We really don't have anything like that on August 22nd, 2025. We covered the 3 steps for a probabilistic trend change earlier in this window here. This is a nice converging strong look. When's the last time we've had a look similar to this? Right down here, things went fairly well walking forward from this point longer term. This looks even better. Again, reference points that we've covered in the past. S&P 500 closed above the 20-day moving average in blue all the way out to the upward sloping 250-day moving average in black post-Powell. For us, a daily cloud is really too sensitive for our time frame, but it also tells us something about trying to remain patient when the daily cloud is still checking all of the bullish boxes at the end of last week, and that's the case at the end of this week. We also covered this chart in this window here. 3 steps for a probabilistic trend change also has that tight and constructive converging trend look. S&P 500 equal weight closed on Friday, August 22nd at a new all-time high above all the moving averages spanning between the 20-day and the 250-day. This is what the 2-year Treasury yield looks like when the market's concerned about inflation in here. This is January of 2022. We don't have anything like that anywhere in 2025. Over here, market's concerned about inflation and Fed policy. Over here, not so much. Media keeps telling us that we should be concerned about inflation. This is what the chart of BSV looks like when the market starts to get concerned about inflation. This is what the chart has looked like in calendar year 2025. Everything that we just said about the last chart applies to this chart. Pause your video player, read this, look at this, and compare it to the present day. January of 2022 really doesn't look anything like August 22nd of 2025. Notice this look here Thursday night before Powell. That was a good look. Remember earlier in the video when we said over the past 8 months we've covered numerous charts that told us market participants weren't particularly concerned, especially overly concerned, in a show-stopping manner that inflation and tariffs were a problem. This is one of those charts. Compare the look of the chart over here to the look of the chart over here. Haven't even made a run at this trend line. Probably fair to say all of the charts that we've just covered tend to align with, rather than contradict, the topics that we covered in last week's video and the same topics that we've been covering for years. If the data and the evidence and the charts start to shift and move away from the base case, then we have to be willing to reassess those probabilities. And if you fully respect the concepts of the market doesn't care what you think, and you have absolutely, positively no idea what's going to happen next, it's much, much easier to recognize when the weight of the evidence begins to shift. And we all know, even if really, really good things happen, there's no free lunch in the stock market. Nothing is easy. Significant, painful, and fear-inducing drawdowns are 100% normal and to be expected. Given what we know today, including this tweet here from Friday's session, the weight of the evidence is allowing us to think longer term. And we all know the only way that we can properly monitor new data and potential bearish shifts in the charts is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.